Welcome back. Let's dive into one of the most operationally important parts of the insurance value chain: policy administration and servicing. Once a policy is issued, the real journey begins. Insurers must manage and support the policy throughout its life cycle, ensuring accuracy, continuity, and great customer experience. Let's look at the key sub-processes that make this possible. First, policy creation and maintenance. This is where the policy details are recorded, validated, and stored in the system. It includes capturing the insured's information, coverage details, and terms of the contract. Throughout the policy's lifetime, updates like change of address or beneficiary are made here to keep everything accurate and current. Next, endorsements and renewals. Endorsements are modifications to an existing policy, such as adding a new vehicle or changing coverage limits. Renewals happen when the policy term ends and coverage needs to be extended, often involving updated risk evaluation and premium calculation. Both are critical to ensure continuous protection for the policyholder. Then comes billing and payment management. This process handles the generation of invoices, premium collections, refunds, and reconciliation. It ensures the policy remains active and compliant while also maintaining transparency in financial transactions. And finally, customer inquiry handling. Policyholders often have questions or service requests, from understanding their coverage to requesting policy documents. A responsive, efficient service desk plays a vital role in customer satisfaction and retention. In short, policy administration and servicing is the engine room of insurance operations, quietly powering customer relationships, compliance, and business continuity. Now let's talk about one of the most crucial stages in the insurance value chain: claims management. This is the moment of truth for every insurance company. The point where the insurer fulfills its promise to the customer. A well-managed claims process not only ensures fairness and accuracy, but also builds lasting trust. Let's walk through the key sub-processes that make it all work. First, the first notice of loss, or FNOL. This is when the policyholder reports an incident, like a car accident, property damage, or hospitalization. It's the first interaction in the claims journey and involves capturing key details like the policy number, loss description, and date of occurrence. Efficient FNOL handling sets the tone for the customer experience. Next, investigation and validation. Once a claim is reported, the insurer verifies whether the policy covers the loss and whether all conditions are met. This may include reviewing documents, inspecting damage, or consulting experts. The goal is to confirm authenticity and ensure that only valid claims are processed. Then comes settlement calculation and disbursement. After validation, the claim amount is calculated based on policy terms, coverage limits, and deductibles. Once approved, payments are released to the customer or service provider. Quick and accurate settlements are key to customer satisfaction. And finally, fraud detection and subrogation. Insurers actively monitor for suspicious patterns to prevent fraudulent claims. In some cases, when another party is responsible for the loss, the insurer seeks recovery from that party, a process called subrogation. Together, these sub-processes ensure that claims are handled efficiently, transparently, and fairly, turning a challenging moment for customers into one of reassurance and trust. Now let's explore a critical part of the insurance value chain: reinsurance and risk management. This function ensures that insurers remain financially stable and resilient, even when large or unexpected losses occur. Think of it as insurance for insurance companies, a safety net that protects them from catastrophic risk. Let's look at the key sub-processes that make this possible. First, reinsurance treaty setup. This is where insurers and reinsurers agree on the terms and conditions of risk sharing. Treaties define what portion of risk will be transferred, how claims will be settled, and what premiums will be paid. This partnership allows insurers to underwrite more business with confidence, knowing they have backup protection. Next, catastrophe modeling. Insurers use advanced statistical models and simulations to predict the potential impact of large-scale events like hurricanes, earthquakes, or floods. These models help estimate possible losses and guide both pricing and reinsurance decisions. Then comes portfolio risk analysis. This process involves assessing the overall mix of policies the insurer holds, by geography, product line, or exposure type, to identify concentrations of risk. The goal is to maintain a balanced, diversified portfolio that minimizes financial volatility. Finally, exposure management. Here, insurers continuously monitor their total exposure to various risks, ensuring they don't exceed predefined thresholds or regulatory limits. This helps in making informed decisions about underwriting new policies or seeking additional reinsurance coverage. Together, these sub-processes form the backbone of financial stability in the insurance industry, helping insurers stay strong, even in the face of uncertainty. If you enjoyed this session, please hit the like button and subscribe to the channel. Your support will encourage me to keep creating more informative and engaging content. Thank you for watching and see you in the next video.